Good morning, traders. It's Friday, March 27th. Taking a look at the charts. Going to start off with a kind of a big picture view and going back to the Nasdaq 2000 market top. Now let's take a look at this psychology of the market. Now, in the grand scheme of things, last year felt a lot like it was that euphoric stage right here where the market rallied 27% on the year, just ripped to the upside, never looked back, and everyone was just piling into stocks. And then we got this big sell-off here in March. And that was a huge sell-off. Now, back in the day, I'll show you what NASDAQ did. NASDAQ fell 40%, and then it rallied up over the next 5 months, 45%. And then it went into the full-out bear market, started the first real leg to the downside. And this is where everyone gets complacent. They think there's all good value here and all through here, and they accumulate, but more or less is distribution going on, and the market sells off and goes into a multi-year bear market, or at least a year-long bear market. Now, what is interesting about this phase right here that we've saw, which is the euphoric rally, everybody piling in, and this sharp pullback. Back in 2000, we saw all the tech stocks, huge funding. They ripped to the upside, caused this massive rally in the stock market. And then when earnings started to roll out and everybody realized there are no earnings, people aren't buying online, it was ahead of its time. Everybody saw the writing on the wall that there are no earnings, so the value of them should be discounted. And that's why once everybody saw these companies were just money pits, the market fell 40% in a very short period of time. Now, if we go to today's market, we've got a similar type of setup. We had euphoric stage last year, market rallied 27%, and then we saw the virus come, and the writing was on the wall. Everyone could see that earnings is going to be bad across the board for everyone, including more so individuals and small businesses this time around. And when everybody sees that, obviously earnings are going to be down. The stock market needs to get reevaluated. So everyone sold price. So let's go back to 2000. Here is the 2000 market top. And it's pretty self-explanatory. Here is the euphoric stage, ripping to the upside in early 2000. And then everyone saw what was happening, that there were no earnings. And the market literally in 2 months collapsed about 35%. It ended up having a bounce and then came back, made a lower low to make 40%. But it did end up taking 4 or 5 months of the market kind of moving higher, and it retraced 61%, a measured fib retrace from the high down to this low. It hit that 61, and then it rolled over, and then eventually it broke this level here, and that's when really took off to the downside. It ended up continuing to go much lower after this, but I just wanted to balance the chart out just to give you an idea of this topping phase. So where I think we're at here is this kind of complacency, this bear market rally. I think you can see here rallied 44.2% to the upside, which is a big move, but really it's less than half of this move that we saw, the collapse. So that's kind of where we are. Of course, it was 2000, which is a more or less a decade number, and it played out over the next year or two going forward. And the market has this 20-year cycle that it likes to kind of follow. Now, if we go and take a look over at this year, here's the 2020 market top. Of course, 20 years later, it's also a decade number, which means 2010, 2020, 2030. All these decade numbers typically are turning points or big consolidation patterns. And here we are with the euphoric stage. We had a 32% pullback or crash, and now the market is working its way up, and I think it's got about a 30% upside to the 618 retracement level. And from there, I think we start to see the market sell off, and we could see a pretty big sell-off going into late 2021. That's if this pattern plays out similar, which it looks and feels a lot like the pattern. We've broken these previous lows on the chart, just like in 2000. You get some chatter through here, and once you pierce those, then you're going up here for a bear market rally. And ideally, we want to see this market continue to consolidate and work itself higher. And we want to get a nice short signal where we get an inverse ETF and we can play this downside move. Catching a move that drops straight down is very difficult, especially when you're in a bull market, because you're not looking to play the downside. In terms of shorting stocks, we're looking to get long bonds. So as this drops, bonds go parabolic, which they did, and we played that. But then the bottom really fell out and it continued to go. But that's unpredictable. That's not the norm. This is just happens to be a major, I think, turning point in the stock market. So you can't catch all those type of moves. So overall, that's where we stand.